We have just reached the highest interest rate since well over 20 years ago and are now sitting at 5.25% to 5.5% federal funds rate. Many believe that this may very well be the last hike for now. What this means is that we might see bond yields starting to come down soon. In fact, there are already signs of this happening. Singapore government bond yields that reached 4.3% back in December have come down since then. Same for home loans, which also came down from its peak from just a few months ago. Which brings us to the question, is this a good time to invest in Singapore savings bond to get an average return of 3.16%? Or should we go for T-bills to get an even higher return of 3.7%? To answer this, let's do a quick refresher on how SSB and T-bills work, just in case you don't blur later on. First, both SSB and T-bills are government bonds, and they are extremely safe investments as they are fully backed by the Singapore government, who has a fantastic AAA credit rating. T-bills have a much shorter maturity period of either 6 months or 1 year, while SSB have a much longer 10-year maturity period. And while T-bills pay out interest at maturity, SSB pays out interest every 6 months. But the most important difference is that for T-bills, if you try to redeem before it matures, you have to sell them on the open market, and chances are you will sell them at a loss as the liquidity in the open market is pretty low. Whereas for SSB, it's a lot more liquid because you can withdraw them anytime you want and get back your money without any loss. But here's an interesting question. Why even look at government bonds at all? Why not just park our money in high-yield savings accounts that can easily give us a higher return? For example, GSS that can give us a 3.48% daily compound interest. Oh, sorry, it's now dropped to 2.68% interest. Or if you can fulfill the salary crediting criteria, bank savings accounts like UOB One and OCBC 360 that can give us 3.85% interest and more. Or what about the super popular money market funds that currently gives 3.7%? Here's why. If we think back to 2022, when the Fed was still raising interest rates fast and furious like nobody's business, you might recall that banks were also raising savings accounts interest rates not just once, but twice. That is how fast things can change. A good example is bank fixed deposit rates. Earlier this year, they were giving as much as 4.08% return. But now, this has dropped to just 2.7%. That's why if you don't have an immediate need for the money, it's better to park the money in government bonds to lock the use for a longer period. Quick pause, here's a super good news. Weeboo's Fund Any Amount promo is now back. By just funding any amount and keeping the money there for 30 days, you'll get a total of 8 free stocks, all without doing any trading. So essentially, they are giving away free money. Each stock is worth anywhere from $3 all the way to $100. Which means you'll get up to 800 USD worth of free shares. Besides that, you will also get to enjoy awesome features with Weeboo, such as the $0 commission free trades, auto investment which lets you easily dollar cost average into your favorite stocks. So if you have not signed up to Weeboo yet, you can sign up using my link down below. With that being said, let's get back to the video. However, here's something interesting. If we check the Fed rate prediction, many people believe that the Fed will hold the rates steady at current levels, then only start to lower rates by March 2024. Or in other words, if things played out as expected, rates would remain high for over 1 year. If that's the case, how would that affect bond yields? First, bond yields largely correlate to the federal funds rate. Check this out. This is the federal funds rate plus the 10-year treasury yield. You can see that in the past, as the federal funds rate went down, the treasury yield will also slowly trend downwards. And the shorter the bond duration, the higher the correlation. This means that if the federal funds rate were to hold steady for 1 year, bond yields would largely remain unchanged. This sentiment is echoed by analysts. For example, one analyst from DBS foresees that T-bill yields will likely range between 3.5 to 3.8%. Another analyst also thinks that T-bill yields have peaked and would hover around the mid 3% range or even slightly lower, then eventually starts dropping the moment the Fed decides to cut interest rates. However, all this is just assuming that the federal funds rate is kept at current levels. As we have seen from the bank collapsing saga, fun times, unexpected things may still happen. For example, recession. Depending on who you ask, some believe that a recession will no longer happen, while 93% of CEOs still feel that a recession could still happen. But what does the data say? 1. While GDP growth has slowed down since 2022, it still remains relatively strong. 2. The high inflation rate has been steadily trending downwards, which is also a good thing. And 3. The latest US job market is still strong, while unemployment rates remain low. So all is good and there's no more recession, right? Well, yes, but no. While core inflation has come down a lot and is now sitting at 4.8%, our Papa Power still thinks that inflation has a long way to go before reaching the Fed's target of 2%. Also, while the job market being strong is a good thing for workers, it also signals that service inflation will remain strong. And as shown, service inflation has barely came down from its peak. So unless the job market cools even more, the inflation rate will still remain high, or even worse, start going back up. That's why Papa Power say that it's certainly possible that they will raise rates again depending on the data. Which brings us to this chart by JP Morgan. If a recession did indeed happen, the Fed will start cutting rates earlier than expected. And this will cause all our bond yields, bank interest rates to come down too. So which is a better investment to lock in the high yields? Is it SSB or T-bills? It mostly depends on one thing. When do you need the money? If you need the money after 6 months, like maybe you are saving up for your wedding next year or are preparing to renovate your home soon, in that case, T-bill is the way to go, as you get to earn a guaranteed return for 6 months and get it back in time to pay for your expenses. But if you don't need the money anytime soon, it's better to go with SSB to lock in the yield for 10 years. For example, maybe you are saving up for your kids' education 15 years later, or maybe you are looking for a place to park a portion of your retirement funds. In that case, SSB is a better choice. Sure, there are endowment plans out there that can achieve the same results, but the biggest advantage of SSB over endowment plans is that it gives you the flexibility to withdraw the money whenever you want. This is useful in a few ways. 1. Maybe you suddenly need the money now. In that case, you can redeem the bond and get back your money earlier. 2. Maybe you saw that the new SSB gives a higher return. In that case, you can redeem your existing SSB that has a lower return, then reinvest the money back into a new SSB. Here's a pro tip. There's a website called ilovessb.com which lets you predict the following month's SSB return, plus help you determine whether it's profitable to swap your existing SSB with a new SSB or not. However, one thing to take note about SSB is the interest usually starts out lower, and the longer you hold the bond, the higher the interest will go. You will only earn the advertised average return if you manage to hold the bond for the entire 10 years. But besides that, T-bill has one advantage over SSB, and that is you are able to invest your CPF money into T-bills but not SSB. Right now, with T-bills giving about 3.7%, you are able to invest your CPF OA money into T-bills and easily get a much higher return than just 2.5%. But just take note, because of how CPF calculates interest based on the lowest amounts for the month, if you do decide to invest your CPF money into T-bills, you need to make sure that you are earning above a certain yield in order to break even. As for myself, this is how I'm currently doing it. For emergency funds, I'm splitting them into 2 parts. One in a high-yield savings account to earn up to 3.85% interest, and another part in money market funds to earn around 3.7%. For my short-term savings, aka money that I might need in the near future, such as for holiday, renovation or child expenses, I'm parking them in SSB to earn a 3% average yield. Then for my CPF OA money, I'm investing them into T-bills to earn 3.7% return, while using competitive bid to make sure that I'm earning a higher yield than CPF. As for the rest of my money that I don't need within the next 10 years, I'm just consistently investing them. Because recession or no recession, it has been proven that stocks will outperform bonds and cash over the long term. Anyway, that's all for this video. Hopefully, you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.